Now let's move to how to the project the balance sheet of the long-term planning, and we'll also identify the additional fund needed, assuming that we issue the new common stock. If not necessary to issue this new common stock, definitely there will be the excess cash, which is actual free cash flow generated by this business on the valuing the the venture's value, right? Based on the FCFE model. Okay, we still use right the percentage of the sales, right? This percentage of the sales, right? And then the accounts receivable also based on the percentage of sales. This, so the 10% of accounts receivable inventory. Then why we can use this? Because the accounts receivable inventory or some fixed asset or the current liability is based on actual operation and the investment that related to this increase of the sales. So that's why we can correlate this percentage of each year's sales. Net fixed asset also the 50, right, divided by the sales. So we got it. And then finally the current liability also percentage of the sales, right? So we got this the percentage of the sales on the balance sheet as well. So first, required cash. How do we get this required cash? This percentage must be right linking this sales for the projected years. Then let's just drag. Excess cash amount we haven't decided yet, because we cannot decide it at this point, because the excess cash is based on the comparison between total asset and total liability and equity. If the total liability and equity is greater than a total asset, that means okay, the company now generated the excess cash, right? But if total asset is greater than total liability and equity, that means, right, they need more cash. They need more cash. That means the shortage of the cash that will be covered by made up by this additional fund needed. Okay, we'll see how we find and how to calculate excess cash or AFN. Here, accounts receivable is again the percentage of this. Oh, sorry. Percentage of the sales. Then we linked all this, the projected year's balance of accounts receivable, and then this inventory also 10% of right corresponding the sales amount. Then total current asset is the sum of all this current asset balance accounts here. Then we collect this. Again, this is not a full amount because we have to find if there is the excess cash or not. The gross fixed asset is here. We have some tricky point. We do not calculate the gross fixed asset directly because we have an assumption that here okay, the depreciation can be forecasted 8% in net fixed asset, right? Net fixed asset here, and then we don't have any other information here. And then that means the gross fixed asset, you can start the gross fixed asset if you can calculate from the depreciation from the gross fixed asset. But this case is not. The assumption we are given is net fixed asset that will be shown on the balance sheet, right? So we have to start from calculating this net fixed asset, and then we calculate accumulated depreciation based on the percentage of the depreciation we calculate here, and then we add this the new depreciation to the accumulated depreciation, so that we can get the gross fixed asset in backward, right? For example, here, net fixed asset. Now, this 25% times, right, the sales, and then we can just drag it to the right. Accumulate depreciation. Before this, you found, right? You found it. Do you remember that we discussed about the depreciation, right? How we calculate depreciation, right? That was the percentage of the net fixed asset, 8%, right? Now it is automatically the generated here, the depreciation. Now this depreciation expense should be added to the accumulated depreciation, right? Because sum of all the depreciation is the accumulated depreciation. Now we add all this, the depreciation expense, annual depreciation expense, onto the accumulated depreciation. In order to get this net fixed asset subtracted by this accumulated depreciation, now the gross fixed asset must be sum this to up, right? The minus is sum. So we got this 8,500, which is gross fixed asset. For example, 8,500 minus 1,000 is net fixed asset balance. Is that correct? Right. So we got it. And then total asset balance, I'm going to sum first. Let's put, because we already calculate this, and only one is net fixed asset, which is long-term asset. And then let's just drag to the right. So we have this balances, right? We have this the total asset balances. Now, at the same time, we calculate depreciation on the income statement. Now, accounts payable is simply, one more time, is fixed times the sales. Then let's just drag. Also, the 5% is the accrued liability times the 30,000. Then let's drag to the right. The bank loan, we assume there's no changes throughout the business because we are going to issue stock, right? But we will use this line of credit based on this assumption as described above on the description section, right? Now the total current liability is just the sum of these three balances. Then let's just drag. Now skipping this the additional funding needed because we don't know yet if we need the AFN or not necessary to issue common stock, additional financing needed, but because we have excess cash. But we have to identify. Here, the common stock doesn't change. There's no other information of the common stock changes, like repurchase or blah, blah, blah. Because this, if we need the new common stock, we'll use this account, right? So it is going to be the same. Now, retained earning, you must be very careful because retained earning is the sum of all the net income or loss of the business, right, throughout the years. So what account do you want to add? There you go, the net income, right? We must add the net income so that this retained earning increased every period, right? So the total equity is sum of, based on the assumption that the new capital will be new common stock issued, and the common stock not changing, and then retained earning increased by the net income of that year. And then total equity, how to get it? Right, total current liability, and then the total equity that we include all the liabilities and equities, right? So let's just drag it to the right side. So here is the point. As you can see here, 15,450 is total asset, right? But the total liability and equity is 13,830. That means We already invested, we already increased the sales. How can it increase the sales? Right, we invested some asset, right? We purchased some inventory, right? We increased the fixed asset, right, to make more of the sales. So in order to increase the sales, there must be the capital budgeting, right? Capital input on the asset part, right? That means we need to find, right, how much we need more cash, right? Which is based on, right, the new issuance of the stock. And then this amount, new issuance amount, will be added into somewhere, right? It can be inventories, can be the fixed asset, right? It can be the accounts receivable as well, or some required asset, right? Oh, sorry, not required asset, but yeah, here. And then here, the total liability equity is lower, right? Then, now, what we have to do is now link this 15,450, because now we assume we already invested, right? By issuing new common stock issued. So when we find this, it must be, right? This minus now each the liability account minus and then common stock minus and then retained earning. So that we found 1620 is, right, the additional financing needed. This additional financing needed already, right, already melted into the accounts receivable or required cash or inventory somewhere here, right? And so that we match it. There's no excess cash. Why? Because the company, right, issues a new common stock to cover this total asset. And then next year, how to start next year? Now the company, this is the balance, right? We should start from the ending balance for the beginning balance of the next year, right? So which one is greater? Now 21,630 and 20,166 for the total liability and equity. That means, right, we need to finance more the additional financing they needed, because 21,630, right? We put a more the asset than the total liability and equities. So now we need this first match it this 21, which is greater one, right? And then this amount will be now by just increasing like this. And then we get the new balance of, right, additional financing needed. That means the difference between two, right, is the increase in AFN. Again, this is the balance, so that we can balance out the total asset and total liability and equity. You guys understand? So there's no excess cash throughout 2022, 2023. That means the company must issue new common stock for the new capital to make up the shortage of cash or shortage of the asset, and then here additionally the funds are needed in this new common stock. And then let's get started one more time, because the ending balance of the last year is the beginning balance of the current year. Oh, by the way, do you see the total liabilities and equity and total asset? Which one is bigger? Right? Now finally total liabilities and equity is bigger, right? That means there is some excess cash amount. Is that right? So we must balance out this. And then in order to match these two, there must be excess cash. Then this cash is calculated 26,551 total liability and equities. Now total asset updated. And then let's calculate just plug-in method, right? plug-in method minus, and then this. So based on this plug-in method, we found the company finally generate excess cash. We can assume that this excess cash is a pseudo dividend that can be distributed to the investors, right? Because it's the excess cash. It can be the dividend as well, right? Which means this is actual cash flows generated by, right, this venture business, which is positive cash. And then there will be, right, finally here, right, one of the total cash flows of equity 2024, which is positive amount. Okay, in the same way, the balance, ending balance is started from here, and then, right, like this. So which one is bigger then? Now, which one is bigger? 29 and 30. Wow, we still, right, still this liability and equity bigger. That means there is, right, additional excess cash. So how do you now it's very easy. You can just drag to the right. Oh, sorry, we have to match this balance first, and then let's just drag to the right, and then we now increase the excess cash, right? The difference between 2024 excess cash and 2025 excess cash is the free cash flows generated by that business in 2025, right? And then here, the last year, once again, which one is bigger? Total liability and equity is greater, right? So definitely we'll also start from, we need to start from this balance, the ending balance as a beginning balance. And which one is greater? Right, the total liability and equity is definitely greater. So we do not adjust this, but here, let's just match this total asset and total liability, and then drag to the right. So it has been increased, right? Total excess cash increased. The increase in the excess cash between 2025 and 2026 is free cash flow generated by the firm. Okay, that's how we build the balance sheet. It's a little bit the complicated, because in this case the company has the two cases of additional funding needed, and then finally excess cash. But when we calculate the venture's stock valuation, at the end of the day, the company must have excess cash in 2026, right? Because we assume that 2026 finally the company is no longer the startup stage or the development stage or survival stage. It's already the rapid growth stage or the early maturity stages. That's why we assume that the growth rate of this sales is 7%. Okay, let's continue the state of the cash flows. The next video clip.